I'm expecting to go back below 4,000 on gold. If that's the case, silver's going to go lower too. So I do think that 55 is in play. I think 54 to 55 are definitely in play here. I don't expect to get to 50. I don't think 50 is going to get touched. This is bull market. The gold chart, as far as I'm concerned, looks unbelievably healthy here. So even though we had a 29% correction, we're not even close to breaking down, if you will. This is just a bull market correction. Now we bounced a little bit. We're at 41.75 today. So now where are we going? Good news is we're probably going to make a bit of a run here in July and early August. But the bad news is we're not going to go straight up. Problem here is the seasonality. The seasonality is going to bite us a bit. It's not going to allow us just to rip to an all-time high. If it was November 1st, I would basically say we're just going to rip to an all-time high. So what I'm hoping for is a correction. And then in the gold area, I don't think we'll go to 3,500. A lot of people are talking about 3,500. I don't think we'll go there. I think it's going to be 37, 38, 39.
We have seen quite a washout in gold and silver. And just over the last week or so, it seems like we might be turning the corner. What is your take on where we are in the metals markets right now?
Yeah, I think the timing is good because we've had a 5-month correction here in gold. And so, we're getting close to the end. So I think this is a really good opportunity. So we've had basically 5 months of going down. So there wasn't a lot to talk about during those 5 months. And now we're coming out of it, I think. So gold peaked in January at 5,600. And then it bottomed, I think it was last week, at 39.59. So that's a 29% drop in gold. That's not unusual for a bear market. So this is the third gold bull market. So the first two, 1971 to 1980, and then 2002 to 2011, I call them both 9-year runs. Both of those had significant corrections. So the average is 25 to 30%. So this isn't out of the norm. 5 to 7 month, a significant correction in the bull market. So the bull market isn't over just because we had this 29% drawdown. As a matter of fact, the 200-week moving average is 2,800, and I don't think we're going to go down and get anywhere close to that. So this is bull market. The gold chart, as far as I'm concerned, looks unbelievably healthy here. So even though we had a 29% correction, we're not even close to breaking down, if you will. This is just a bull market correction.
A brutal correction often does more to strengthen a bull market than a euphoric rally ever could. Don Durrett notes that a near 30% decline fits historical precious metals cycles, yet most headlines treat it like the trend has already failed. That's where retail sentiment and institutional positioning usually diverge. Patient investors often benefit when fear peaks before fundamentals deteriorate. Next, Don Durrett reveals why this correction may be healthier than the financial media wants investors to believe.
And so now we bounced a little bit. We're at 41.75 today, Friday, July 3rd. Which is now down 25%. So we've had a little bit of a crawlback, but we're still kind of bouncing down there at the bottom. Silver had a high of 121 and went all the way down to 56, which was a 54% correction. And now it's at 62. It's off 48% now. So even silver. So they're both 4,160 that was kind of the floor I was looking for. We went past it. I thought those levels would hold, and they didn't. And so that was kind of a bind. Those were both 200-day moving averages. We went under both of them twice, 2 weeks ago, and then last week, we went under them again. So it was basically, we had basically a false breakout. And then we went back and we retested again the 200-day moving average. So we had 2 buying opportunities in June. The HUI high of 989, and it went all the way to 624, which is a 37% correction. Painful for many, but not as painful as I've seen in the past. Some people were down 50%. A lot of people were down around 40, but now it's backed off. We're down 32%. The HUI is down 32, and that can squeeze fairly quickly. we have a bit of divergence where the miners didn't go down as low as before. So the miners are basically showing a little bit of strength here on these corrections.
Markets celebrate small rebounds while smart money studies who quietly stopped selling. According to Don Durrett, miners holding up better than previous lows could signal underlying institutional accumulation despite widespread pessimism. False breakdowns frequently exhaust weak hands before stronger buyers begin building positions without attracting attention. Missing that transition can cost far more than enduring temporary volatility. Next, Don Durrett exposes why miner resilience may contradict the bearish narrative dominating financial headlines.
So now where are we going? So the good news is we're probably going to make a bit of a run here in July and early August. But the bad news is we're not going to go straight up. The all-time high in gold, 5,600, and we're sitting at 41.75. We're not just going to rip all the way to 5,600. It's going to take some work. As a matter of fact, I've already created my list for the next correction. I don't think that 4,000 is going to hold here as a bottom for the year. I expect to go back below 4,000, so that's ugly. So even if we make a run here, so I did buy this dip, and now I'm created a list. I'm ready to buy the next one, but so I'm going to wait for the next correction, and I hope we don't have it. But the problem is seasonality. So even if gold decides to make a little bit of a run here in July and August, once you get to mid-August, from mid-August to mid-October, that's ugly seasonality for the mining stocks. I mean, for the S&P 500. So I think sometime between the middle of August and middle of October, we're going to see a correction on Wall Street. The question is how deep? I think 5% absolutely, but it could go 10 or 20. We don't know. But I do think that when that correction comes, gold and silver are going to get whacked once again. So we're not out of the woods. I mean, we've had this 6-month correction. Now, normally, when you have a deep correction in a bull market, you get higher highs. You get higher highs, higher lows.
Timing has punished impatient investors far more often than weak fundamentals ever have. What Don Durrett is highlighting is that seasonality, not long-term conviction, may dictate the market's next move despite improving technicals. History shows liquidity shocks can temporarily drag quality assets lower before the primary trend resumes. Investors who plan for volatility instead of fearing it usually preserve both capital and conviction. Next, Don Durrett reveals why the next sell-off could create the strongest buying window of the year.
But the problem here is the seasonality. The seasonality is going to bite us a bit. It's not going to allow us just to rip to an all-time high. If it was November 1st, I would basically say we're just going to rip to an all-time high. So what I'm hoping for is a correction. So we go up, say, somewhere between 4,500 and maybe 5,000 before this next correction comes. And I hope that when the next correction comes, that it holds at 4,200. We don't even go back and retest 41 or 4,000. But I don't think that's going to happen. So I definitely don't think 4,500 will hold once we get above it. So I'm thinking we're going to have to wait. And then I'm hoping to get above 5,000 by November 1st. And I might be begging, we might not get there. But if we get above 5,000 on November 1st, at that point, the S&P's kind of the problem, that headwind is seasonality is gone. And now gold and silver, I think, are going to start ripping in November and December and January. So I become very bullish once we get to November 1st. At that point, you want to have bought this dip, and you're going to want to buy that next dip, because when the next run comes, that's going to be the second leg. So the first leg started in August of last year when silver went from 35 to 120. And gold was also ripping at that time.
The biggest investing mistake isn't buying too early. It's running out of cash before opportunity arrives. Don Durrett's argument suggests disciplined positioning matters more than chasing every rally when seasonal headwinds remain active. Markets often reward investors who preserve capital during uncertain periods rather than forcing aggressive entries. A measured approach today may produce dramatically better risk-adjusted returns later. Next, Don Durrett unravels why November could completely change the risk-reward equation for precious metals.
Gold went, I don't know what it was in August, but I think it was below 4,000 and it went to 5,600. So that next leg up, when it comes, you want to be on the train. You don't want to be off the train. And I think that next leg is going to start in November is my expectation. So I'm very bullish for the end of the year, not so bullish in the next quarter. But I could be wrong here. And we can talk a little bit about AI and about and talk a little bit about the Iranian war and how that's going to impact the S&P.
I certainly would like to get into that here. I did want to look at the price points you're looking for, maybe a further pullback. For silver, we went just below $56. Sorry, $56. For silver, we went right below $56, and gold, we just dipped below 4,000. A lot of people have their eyes on that previous high way back last year, $54, and then also just the $50 psychological level being a clear floor. Do you anticipate silver could go any amount below that that $50 level, or what are your price targets on the downside if we do see another flush out?
Yeah, so I'm expecting another correction. So I said that earlier. I'm expecting to go back below 4,000 on gold. So if that's the case, silver's going to go lower too. So I do think that 55 is in play. I think 54 to 55 are definitely in play here. I don't expect to get to 50. I don't think 50 is going to get touched.
The loudest forecasts usually appear just as probabilities begin shifting in the opposite direction. This is where Don Durrett's thesis shifts from optimism to disciplined expectation by separating temporary weakness from structural damage. Investors obsessed with round number targets often overlook how markets reverse before consensus becomes comfortable. Protecting wealth means respecting probabilities instead of emotional headlines. Next, Don Durrett exposes why silver's most feared downside scenario may already be misleading investors.
It's possible we could go down that low, but I'm looking more in the 54 area. And then in the gold area, I don't think we'll go to 3,500. A lot of people are talking about 3,500. I don't think we'll go there. I think it's going to be 37, 38, 39, somewhere in there is my expectation. So this last correction at $4,000 gold, that was a beautiful entry point because I don't think we're going much below those levels. And if you didn't buy there, you're probably going to regret it, I think, over time. So those are kind of my floors.
Now, with respect to what you're expecting in the coming months here, what are some triggers of that final washout that you would expect, and what is going to signal to you that we're off to the races now, and we're really done with this correction?
So it's all about AI and the war in Iran ending and the S&P 500. So the only chart that matters, in my opinion, is the gold to S&P 500 ratio. That's the only chart you really need to look at if you're a gold and silver miner. So it's currently at 0.55. So we need to get to 0.77 to get our wind at our back. So when is the coast free? The coast is free when it gets to 0.77. We're currently at 0.55. So the way you get to 0.55 is you divide the current gold price, which is $41.75, by the current S&P, which is $74.83. Gives you 0.55.
Everyone debates gold's price, while the more revealing signal hides in its performance against stocks. Don Durrett notes that the gold to S&P ratio may reveal institutional rotation long before headlines acknowledge changing market leadership. Relative strength often exposes capital flows that price charts alone cannot fully explain. Investors watching only dollar prices risk missing the bigger macro transition. Next, Don Durrett reveals the ratio that could confirm institutional money is finally abandoning equities.
In 1980, the average in January was a 6, which is kind of insane. So gold was 6 times the S&P 500 average in January 1980. 6. Now we're currently 0.55. Now we're not going back to 6, but I do think we're going to go to 2, and we're currently at 0.55. So basically double again kind of situation here. And that's just for gold outperforming the S&P. So if the gold outperforms the S&P, so what we're looking for, the reason why this chart is so useful, if you will, is it not only does it show you rotation, as it gets better, 0.5, 0.6, 0.7, 0.8, all the way to 2. As it rotates, as that ratio squeezes and improves in our favor, that is showing rotation out of the S&P and into gold. So it's showing you rotation, massive amounts of money rotating, but it's also showing you sentiment. Because as that chart starts turning in our favor, it basically shows you sentiment. It's showing you money going into the miners, going into gold. And so what I want to get above that 0.77 level. And once we get above that 0.77 level, I firmly believe it's going to trend all the way to 2. And so that's when we win the war. So there's basically been 3 battles here that, as in gold and silver investors, we need to win. The first one was gold breaking out. And that happened in December of 19, believe it or not. Go all the way back to December.
When capital quietly rotates, public opinion almost always catches up months after the opportunity. According to Don Durrett, improving gold-to-equity performance may signal institutional allocation changes rather than speculative enthusiasm. Pension funds and large asset managers typically shift gradually, leaving subtle footprints before dramatic price moves emerge. Watching those footprints matters more than chasing headlines. Next, Don Durrett exposes why sentiment changes only after institutional positioning is already well underway.
Go look at the chart. Gold was at $1,500. But by the time you got to the end of January in 2020, gold was kind of on its way. It didn't really any correction. It was basically up. It was upward trend, but it didn't really confirm that breakout from 2020 until we got to 24. But it was kind of a slow slog from 1,500 to 2,000. But it didn't break down. It was kind of slowly going up. It had an upward trend. It wasn't, but it was slow, very slow and sluggish from 2020 to 2024. And then in 2024, it was at 2,000. So you say, oh, Don, it only went at $500 and, $500 in 4 years. But that was $100 a year. It's kind of trending up. But in February of 24, it was at 2,050, and it just took off. But silver, so that's the first battle. It was confirmed in February. In end of March, I basically said, that's it. Gold broke out. It's off to the races here. And it absolutely has. We went from 2,000 all the way to 5,600, and now we've had this correction back. But this correction, it doesn't stand in the face of that breakout. And so now silver, it didn't join the party in 24. And we had to wait 18 months. We had to wait all the way until August of 25 before silver joined the party. So gold was way ahead. We're waiting for gold. It was just sluggish.
The market's slowest advances often become the foundation for its fastest breakouts later. What Don Durrett is highlighting is that multi-year consolidation built conviction before momentum finally accelerated beyond expectations. Most investors abandon positions during those quiet years, handing stronger hands attractive entry prices. Patience frequently outperforms prediction across major commodity cycles. Next, Don Durrett reveals why silver's delayed breakout may carry an overlooked strategic advantage.
Finally, it was at $35 in August 25, and it just said, okay, here I go, it's time. And it went to 120. The final battle, so that we needed to win those 2 battles. We needed gold to break out, we need silver to confirm, and then we need the miners to confirm. But the last piece of the puzzle, yeah, by the way, we needed the miners. The third battle is the miners. The miners joined with silver. The miners are the HUI, which broke out in August. But the final battle is sentiment. And the way that you get sentiment, you have to have gold outperforming the stock market. So that's what you had from 2002 to 2011, gold outperformed the stock market. The same thing from 1972 to 1980, gold outperformed. So from 1972 to 1980, gold went from $35 to $800. And then in 2002, it went from 250 to 1900, right? So 8x. Gold was outperforming the stock market. So that hasn't happened in this bull market. In this bull market, the S&P has been roaring. It's at 0.55. Gold has not outperformed the stock market. So when it does, that's what we're waiting for. I'm sitting back here. So I'm just stacking shares, waiting for gold to outperform the stock market. And so that's when you get to 0.77. Now, the 0.77 I got from North Star charts on X. They have a beautiful chart that basically shows at 0.7, you get about 0.77 and we're off to the races.
Bull markets become truly powerful only after confidence shifts away from conventional assets. Don Durrett's argument suggests sentiment, not price alone, will determine whether precious metals enter their strongest phase. Many portfolios remain heavily exposed to equities despite growing macro uncertainty and rising fiscal risks. Diversification becomes valuable before consensus admits it's necessary. Next, Don Durrett unravels the institutional signal that could mark the real beginning of the next advance.
It's kind of a, 0.75 to 0.8, somewhere in there. But around 0.77, you're pretty much, we're off to the races here, where gold's going to outperform the stock market. So what is going to make, so I would say you can ignore silver because silver's going to follow gold. Focus on the fundamentals of gold, absolutely, but then also focus on this chart as well. You can look at the fundamentals of gold, but one of the fundamentals of gold is the economy weak, which creates a fear trade into gold. That's the reason why I own gold and silver miners, because I've always thought it was a fait accompli that ultimately the U.S. is going to default on its debt. And if it defaults on a debt, you can imagine the fear trade. The fear trade is going to be off the charts. So that's what I'm waiting for.
Safe haven demand rarely appears without exposing weaknesses elsewhere in the financial system. This is where Don Durrett's thesis shifts from commodity analysis toward broader concerns about sovereign debt and investor confidence. Whether or not such outcomes occur, monitoring systemic risks alongside precious metals offers a more complete framework than headlines alone. Preparation always beats reaction.